Despite dividend stocks doing so well in 2026, there are quite a few that look historically cheap right now. Nike, ticker symbol NKE, currently has a dividend yield of 3.9%. This is basically the highest it's been over the past 5 years, and the highest Nike's dividend yield has been going back all the way to 2007. I recently covered PepsiCo, ticker symbol PEP. That has a forward-looking dividend yield of 4.31%, which is historically high over the past 5 years. We have McDonald's, ticker symbol MCD, at a 2.72% dividend yield, which is near its 5-year high. I just made full deep dives into both McDonald's and PepsiCo, but those are just some examples of blue chip dividend stocks which look cheap right now based on its dividend yield. Today I wanted to find some more, so I screened all 168 stocks on my personal watch list, and I was looking for companies that were above their 90th percentile dividend yield over the past 5 years. So today I'm going to share 7 dividend stocks that are the cheapest they've been in 5 years. With that said, let's roll the intro and get into today's video.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach. This is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. So I used this dividend yield target tracker on my watch list, and I found the companies that were trading above their 90th percentile. And today I'm going to pick 7 that I think are worth discussing with you. For stock number 1, I'm going to pick Accenture, ticker symbol ACN. This is a massive technology consulting company, and they have sold off a ton in the past year and a half. This has boosted their dividend yield to a historically high level. Currently, the forward-looking dividend yield is 3.66%, which is in the 95th percentile. And it was even higher a few weeks ago. I made a video then talking about the stock as well. And it has still rebounded, but it's still historically cheap. And first, let me explain what I mean when I say cheap here. Many dividend investors, they like to optimize their dividend yield on cost, so the amount of dividend payments they get for the price they pay for that share. So with this example of Accenture, if you bought at a 5.24% dividend yield, for every $100 you put into the stock, you would get $5.24 a year in dividends. And that's historically high. The median multiple over the past 5 years is 1.59%. So for every $100 you put into the stock, you would have been getting $1.59 back in dividends that year. So what we're doing here is looking at the dividend yield the stock has traded at over the past 5 years. We can also select the time period to be smaller, 6 years, 1 year, 3 year, 10 year, all time. And we are looking at a distribution of that yield. So how often or how many days the company has been trading at that yield. And Accenture today, even after the stock has rebounded in the past few weeks, it's still in the historically high category. And it actually gets better as we go out to 10 years. Right now, it's in the 98th percentile over 10 years. Accenture stock has historically traded at its 90th percentile being 2.29%. The median over the past 10 years is 1.63%. Typically, this is a low yield company, and that's because the dividend is growing at a high rate, and the overall business was growing at a reliable rate. The company has been growing its dividend for decades. They switched from annual payments to semi-annual payments to a quarterly dividend. And over the past 5 years, the dividend has grown 85%. That's a 13.12% compound annual growth rate. And you can see the most recent dividend increase was 10.14%. And the one prior to that was 14.73%. And the company is not likely to cut their dividend anytime soon. They just had a raise a few quarters ago. The free cash flow payout ratio is 34%, which is in a very sustainable range. The earnings payout ratio is 48%. The second stock I'll share today is Nike, ticker symbol NKE. They are currently far above their 2.8% 90th percentile dividend yield. The forward-looking yield is 3.9%. Now, Nike stock has done terrible for the past 5 years, down 75.6%, and it's down negative 23% over the past 10 years. However, even after that poor performance, it's still a great performer in its all-time view going back to 1985. And with reinvested dividends, it's been even better in that time. After going down 75% over the past 5 years, the company has still grown at an 18.93% compound annual growth rate since 1985 if you reinvested your dividends. Nike has been a reliable dividend payer, paying a quarterly payment for many decades and raising it every single year. And even over the past 5 years, where the stock price has collapsed, Nike's dividend is up 49%. That's an 8.32% compound annual growth rate. However, it's finally slowing down. The latest dividend increase was just 2.5%. And over the past 5 years, Nike today is trading in the 99th percentile dividend yield at 3.9%, with the median over the past 5 years being 1.45%. So Nike stock is way cheaper than it ever has been. In the all-time view, we're at the 100th percentile, and other than the past couple years, the highest Nike stock has been since 2007 was the 2.5% dividend yield in 2009 after the great financial crisis. So if Nike's business starts to rebound a little bit and they can keep paying and growing their dividend over time, this could be an attractive entry point. Overall, I'm not very worried about a dividend cut. However, in 2026, the free cash flow payout ratio is 110%, which could point to this being unsustainable. However, they have had that happen in the past. The earnings payout ratio is 77%. And for most of the past 10 years, though, their earnings payout ratio and free cash flow payout ratio were very sustainable. This used to be a very low payout ratio dividend. And it's not that the dividend growth has gone up that much. It's that the actual earnings and free cash flow have declined that much at Nike. So you can see the adjusted earnings per share for Nike stock is down 44% over the past 5 years. However, they have started rebounding up from that base again. And this latest quarter of 72 cents was the best quarter going back to Q2 of 2025. Nike also just had their best quarter of free cash flow that they've had since Q3 2025. And I haven't been following Nike that closely. I know they've had a lot of management changes in recent years and they're doing some changes to the business. So perhaps they're starting to be on the other side of that. The third stock I'm going to share today is PepsiCo, ticker symbol PEP. The stock is also down 11% over the past 5 years. It's been historically considered a blue chip dividend growth stock. The company is a dividend king with 50 plus years of consecutive annual dividend increases. They recently had a 4% dividend raise 2 quarters ago. And over the past 5 years, they've grown their dividend 37%, which is a 6.6% compound annual growth rate. And based on the past 5 years, Nike's trading at one of its highest yields ever. It's in the 98th percentile at a 4.3% dividend yield. And it's only been higher a couple weeks ago and at a point during 2025 around June. But those have been outliers even over a 10-year period. We're in the 99th percentile right now in the past 10 years. And what's interesting is this comes at the same time that Coca-Cola stock is trading at all-time highs in stock price and likewise trading at one of its lowest forward-looking dividend yields of the past 10 years. It's at the 0th percentile. Now, I'm not worried about a dividend cut at PepsiCo. I did a full stock analysis video if you want more thoughts around that. But the company's growth does need to accelerate as the payout ratio is getting close right now. It's at 92%. But it's always in a historically high range between like 70 and 80%. And the free cash flow payout ratio for 2025 was 99.6%. However, their free cash flow has been improving in the past few quarters, $9.2 billion over the trailing 12 months. And this exceeds the amount of dividends they've paid over the trailing 12 months of $7.8 billion. So overall, I would think that PepsiCo will continue paying a growing dividend for decades to come. Stock number 4 I'm going to share today is McDonald's, ticker symbol MCD. I just made a full stock analysis video on McDonald's. Unlike the others, the stock price is still up 17% over the past 5 years. However, in terms of dividend yield, it is historically high. The forward-looking dividend yield is 2.72%, and we're in the 98th percentile right now at that 2.72% yield. You can see the median over the past 5 years is 2.28%. So McDonald's is always in that low 2% range for the most part. And this is even in the 90th percentile over the past 10 years for McDonald's. Similar to PepsiCo, this is a company with decades and decades and decades of dividend increases. It was a quarterly payer, then it was an annual payer, then it was back to a quarterly payer, and they should be due for their next dividend increase in the coming months. The most recent dividend increase was 5%, and over the past 5 years, the dividend's up 44% at a 7.59% compound annual growth rate. It is sustainable with a 71% free cash flow payout ratio and a 59% earnings per share payout ratio. Stock number 5 I'm going to share today is McCormick Company, ticker symbol MKC. The stock is down 37% over the past 5 years. And the forward-looking dividend yield is 3.61%. This is another dividend aristocrat with decades of consecutive annual dividend increases. Over the past 5 years, the dividend's grown 41% at a 7.14% compound annual growth rate. The most recent dividend increase was 6.67%. And based on the past 5 years, it's in the 93rd percentile right now. And it's gone up a little bit over the past few weeks, but it's still historically high. And that's even more true as we go back over 10 years. It's in the 97th percentile based on the past 10 years. And in that time, the median yield for MKC stock was 1.84%. The payment seems to be sustainable with a 65% free cash flow payout ratio. It's hit this range many times in the past 10 years and continued growing the payment. The earnings per share payout ratio is 61%, which is in line with 2024 and 2023. Stock number 6 I will share today is Lowe's Companies, ticker symbol LOW. If you live in the US, you definitely know this company. They're basically the two main hardware home improvement stores, Home Depot and Lowe's. Stock is up 15.34% over the past 5 years. However, it has gone down quite a bit. It's down 11% year to date. The current forward-looking dividend is $5 per share. Forward-looking dividend yield is 2.28%. And you can see this is a company that has been consistently paying and growing its dividend on an annual basis. And they actually had some crazy high dividend growth over the past 10 years, 257%, 13.5% compound annual growth rate. But this has slowed down over the past 3 years, only up 13.6% at a 4.35% CAGR. They just had a 4.17% dividend raise. Based on the past 5 years, we're in the 97th percentile starting dividend yield. The median over the past 5 years is 1.95%, so this isn't that much of an outlier to the upside. And you can see it's still historically cheap based on the past 10 years as well. However, you have to factor in that dividend growth is slowing at Lowe's. And the dividend payment does look to be sustainable with a 34.5% free cash flow payout ratio and a 39.6% earnings payout ratio. So purely in terms of their cash flow and earnings per share, the dividend payment is sustainable. However, the company's free cash flow and growth has kind of plateaued in recent years. And on a per share basis, a lot of their growth came from these large share repurchases, and they used a ton of debt to do those share repurchases. You can see the massive amount of share repurchases they had from 2009 all the way through to a couple years ago. And as of now, they basically stopped doing the share repurchases. And the 7th and final stock I'm going to share today from my watch list that's above its 90th percentile dividend yield, that will be Procter Gamble, ticker symbol PG. And that's because it's a dividend king. So PG stock, it's only up 2.64% over the past 5 years. And as of right now, it's down about 18 to 19% from its 2026 high in stock price. This is a company that has been paying and growing its quarterly dividend for many, many decades. It's a dividend king, so that means more than 50 consecutive years of annual dividend increases. This is one of the most dominant consumer packaged goods companies in the world, and it typically trades at a premium because of that, and the growth hasn't been that high in recent history. But in terms of its dividend yield, the stock is the cheapest it's been over the past 5 years. It's in the 97th percentile. The median over the past 5 years is 2.49%. However, if we look back over 10 years, it has been cheaper. And just in 2018, you could have gotten the stock at a 3.8 and nearly a 4% dividend yield at one point. So on a 10-year view, we're not in the 90th percentile yet. And going back to 2007, we're actually only at fair value for Procter & Gamble stock. So of the ones that are at the 5-year 90th percentile, this is the one that I'm the least tempted to get in on at this moment. Now, it's a reliable, rock-solid dividend payer. However, dividend growth isn't that high. Over the past 5 years, the dividend's grown 25%. That's a 4.59% compound annual growth rate. The most recent dividend increase was just 3%. It is sustainable with a 64% free cash flow payout ratio and a 63.8% earnings per share payout ratio. And it gets a dividend safety score of an A. So those are 7 dividend stocks trading at historically high dividend yields. I used the yield target tracker on the watch list of dividenddata.com. And to be honest, this is a great feature that saves you a ton of time. You can click 90th percentile, 95th, 98th. You can make a custom one. You can choose 5 or 10 years, and you can apply that to your entire list. So I have it applied to 168 stocks. And it really helps you surface which companies are trading at a potential discount. So if you want to use the same exact tool and all the other stock research tools I've been showing throughout the video, it's all available at dividenddata.com. And right now we have a sale where you can lock in 50% off annual membership. And that's to celebrate the launch of our next generation version of dividenddata.com. It's been out for a few weeks. The feedback has been amazing among users, and the tool will just keep getting better and better. So if you sign up today, you can lock in a discounted price. And if the tool helps you find just one better investment, it way more than pays for itself. So if you want to try it out, the link is in the description and pinned comment of the video, or you can scan the QR code in the bottom right corner of the screen right now. And if you found the video interesting, make sure to leave a like, comment, and subscribe to the channel. And let me know in the comments what company you might want me to deep dive in that I mentioned in this video, or which of the other companies on that list you would like my thoughts on. Because there was about 15 or so there, and I whittled it down to 7, and there were about 3 or 5 that I thought were pretty interesting. And some of them I would actually personally consider buying more than the ones I showed in this video. So with that said, thanks for watching, and I'll see you in the next video.